The world in 2025 is entering a new financial era defined by debt cycles, inflation waves, and technological transformation. The winners will be those who understand how to balance risk and opportunity. If you look closely at the current state of our global economy, you'll notice patterns repeating, patterns that have appeared for centuries. We are once again at a point in the long-term debt cycle where governments, corporations, and households have accumulated enormous levels of debt. History shows that when this happens, societies reach a tipping point where they can no longer grow simply by borrowing more. That is where we stand today, on the edge of a global reset where understanding the mechanics of money, debt, and productivity becomes the most important skill for building and protecting wealth. Throughout history, economic power has shifted from empire to empire, but the causes of those shifts are always the same: overextended debt, internal conflict, currency devaluation, and technological disruption. These forces are now converging once again. Central banks, in an effort to control inflation, have raised interest rates rapidly. Yet, those same interest rate hikes are creating the seeds of the next downturn by making debt harder to service. It's a delicate balance, one that determines who thrives and who collapses in this next phase of the cycle. Understanding this balance is not just about economics, it's about perspective. When Ray Dalio speaks about the machine, he's referring to how the economy operates: millions of independent decisions creating collective outcomes. Once you grasp how the machine works, you stop reacting emotionally to the market's ups and downs and start thinking in terms of cause and effect. You realize that every boom carries the seed of its own bust, and every bust creates the soil for the next boom. That's the rhythm of the economic world, and the key is not to fight it, but to work with it. In 2025, three forces are reshaping that rhythm more dramatically than ever before. The first is the debt cycle, the cumulative buildup of obligations that must eventually be repaid, inflated away, or defaulted on. The second is inflation, not just as a number on a chart, but as a structural force eroding purchasing power, shifting wealth from savers to borrowers. The third is technological transformation, a wave so powerful that it's redefining productivity, employment, and even the meaning of money itself. Let's start with the debt cycle. For over a decade, since the 2008 crisis, the world has lived on borrowed money and artificially low interest rates. Central banks printed trillions of dollars, euros, and yen to keep economies afloat. That worked for a while. It pushed asset prices up and made people feel wealthier. But debt doesn't disappear, it just moves. And today, much of that debt sits on government balance sheets that can no longer afford to raise spending or cut taxes without triggering inflation. The system has reached a point where every choice has consequences, and no choice is without pain. Inflation, the next major force, is the silent thief of wealth. It's not just about rising prices. It's about the loss of confidence in money itself. When people start questioning whether their currency will buy as much tomorrow as it does today, they change behavior. They spend faster. They seek hard assets. They hedge against uncertainty. This shift in mindset is what drives cycles of volatility. Inflation isn't just an economic condition. It's a psychological transformation of trust. And once that trust breaks, the rules of investing change entirely. Now, add technology to that equation. Technology is both a disruptor and a multiplier. It destroys old jobs but creates new industries. It makes production more efficient but also introduces massive inequality between those who adapt and those who don't. In 2025, artificial intelligence, automation, and digital finance are not just tools, they're structural changes to how value is created and distributed. Think of AI as the new electricity, a force so transformative that it reshapes everything from productivity to power dynamics. The investors who understand where this transformation is heading will be the ones who capture exponential returns over the next decade. But understanding these forces isn't enough. What truly matters is how you position yourself within them. That's where the balance between risk and opportunity comes in. In times like these, fear is a powerful emotion. Markets swing, news headlines panic investors, and people rush towards safety. Yet, as history shows, the greatest wealth is built not in times of calm, but in times of change. The key is to recognize that every disruption, no matter how painful, creates opportunity for those who remain calm and informed. The global financial system today is more interconnected than ever, which means small ripples can become global waves. A policy change in Washington or Beijing, a shift in oil prices, or a technological breakthrough in AI can reshape markets overnight. But instead of fearing volatility, the wise investor studies it. Volatility is not the enemy. It's the price you pay for opportunity. When others see chaos, disciplined investors see mispricing, inefficiency, and asymmetry, the very conditions where fortunes are made. To thrive in this environment, one must think differently, not like a trader chasing quick profits, but like an architect designing a resilient system. The question isn't, what's going up? It's, what will survive? Building a portfolio for 2025 isn't about predicting the next hot stock. It's about structuring your wealth so it performs across a wide range of outcomes. You must be ready for inflation and deflation, for booms and recessions, for technological leaps and policy shocks. That requires diversification, not in name, but in substance, spreading risk across truly uncorrelated assets. Another critical aspect is the global power transition. The United States remains strong, but the world is becoming multipolar. China, India, and emerging economies are reshaping trade, energy, and currency dynamics. The U.S. dollar's dominance is being tested as more nations experiment with alternative payment systems and even digital currencies backed by commodities. This shift doesn't mean the dollar will collapse overnight, but it signals a gradual rebalancing of global economic power, and that will change how investors should think about risk, debt, and opportunity. In such a world, knowledge is the most valuable asset. Most people react emotionally to financial news. They panic when markets fall. They chase when markets rise. But those who understand the underlying cycles act with logic. They anticipate. They prepare. They use fear as fuel for insight, not paralysis. The difference between the average investor and the exceptional one isn't intelligence. It's discipline and perspective. The exceptional investor studies the long-term patterns and positions early, while others wait for confirmation that never comes. What 2025 demands is not luck, but literacy, economic literacy, financial literacy, and emotional literacy. You must learn to see the economy as a living system, constantly balancing debt, productivity, and human psychology. If you understand that system, you can navigate it with confidence, not confusion. So, as we step into this new financial era, remember this truth: the world will always change faster than people expect. But those who adapt faster than the world will always stay ahead. The balance between risk and opportunity is not found in prediction. It's found in preparation. The question isn't whether the next storm will come. It's whether you've built a ship strong enough to sail through it. In the end, that's what the 2025 era is about: mastering the rhythm of cycles, harnessing the power of transformation, and using knowledge as your greatest investment. Those who do will not just survive the new age of economics. They'll lead it. Building wealth isn't about chasing returns. It's about identifying assets that thrive under changing economic conditions, assets that produce real value, not just paper gains. That's a truth many investors overlook, especially in times when markets are driven by excitement, speculation, and short-term thinking. Most people confuse making money with creating wealth. They see a price go up and they feel richer. But real wealth is built on assets that continue to produce even when the noise fades and the crowd disappears. In the simplest sense, an asset's value comes from its ability to generate something of lasting worth: cash flow, utility, innovation, or stability. When you buy an asset, you're not just buying numbers on a screen. You're buying a piece of a system that either grows with time or decays with neglect. The difference between the two is what defines whether you're building something enduring or merely speculating. And understanding that difference is one of the most powerful edges you can have as an investor in 2025 and beyond. We live in a world where returns can be deceiving. Over the past decade, unprecedented money printing and low interest rates inflated almost everything, from stocks and bonds to housing and collectibles. People mistook easy liquidity for skill. But now, as the tide of cheap money recedes, we can finally see who was swimming without a strategy. This new environment will expose every weak foundation. It will separate those who invested in real productivity from those who invested in inflated perceptions. Real value is not built on what the market says something is worth today. It's built on what that thing can continue to provide tomorrow. That's why great investors look at fundamentals, earnings, assets, demand, innovation, and sustainability. When Ray Dalio speaks about the machine of the economy, he means that value creation is a mechanical process. Resources are combined through human ingenuity to produce output. When that machine works efficiently, wealth grows. But when people try to shortcut that process, when they chase prices without understanding the productivity beneath them, they're no longer investing. They're gambling on sentiment. In 2025, the markets will continue to fluctuate, currencies will shift, and narratives will rise and fall. But assets that create consistent value will stand firm. Take businesses, for example. The most traditional form of productive assets. A company that can continually innovate, cut costs, and expand its reach will thrive no matter what happens to interest rates or GDP growth. The investors who look beneath the hype and analyze how a company earns its money, how it reinvests profits, and how it adapts to disruption are the ones who end up ahead of the curve. The same principle applies to every other class of asset, from real estate to commodities, from digital infrastructure to intellectual property. You must always ask one question: what does this asset actually produce? Does it generate income? Does it store value? Does it solve a problem that will exist tomorrow? If the answer is yes, it's worth owning. If not, no chart or analyst forecast can save it from eventual decline. The danger most investors face is emotional attachment to numbers. They fall in love with rising prices, confusing momentum for meaning. But markets are driven by cycles, waves of optimism and pessimism that come and go. If your investment thesis relies on sentiment, you are tied to the emotions of the crowd. But if it's grounded in productivity, you're anchored to reality. Reality always wins, even if it takes time. The idea of thriving under changing economic conditions means your portfolio must reflect both offense and defense. In times of inflation, you want assets that rise with prices, real estate, commodities, equities tied to essentials. In times of deflation or contraction, you need assets that preserve liquidity and stability, bonds, short-term cash equivalents, or defensive businesses. You can't know the future, but you can structure your wealth so it benefits from any outcome. That's the essence of balance. And balance isn't achieved by owning everything. It's achieved by owning the right things for the right reasons. The average investor diversifies randomly. The wise investor diversifies intelligently across assets that perform differently under various economic environments. For instance, gold tends to rise when currencies weaken. Equities tend to rise when productivity grows. Bonds perform well when inflation falls. Cash provides optionality when uncertainty is high. By combining assets that move in different directions, you create a system where your risk is spread, not your confusion. One of the biggest mistakes people make is assuming that wealth is built by taking big bets. In reality, it's built by managing risk. The best investors don't aim to be right all the time. They aim to not be wrong too often. They build portfolios that can survive being wrong because they know no one, not even the greatest minds, can predict the future consistently. But you can design your approach so that being wrong doesn't destroy you, and being right compounds your advantage. Think of it like nature. The most resilient species aren't the strongest or the fastest. They're the most adaptable. They evolve when the environment changes. In investing, adaptability means staying informed, reviewing assumptions, and adjusting positions as new information arises. Most people cling to their beliefs even as the world changes around them. But great investors evolve. They don't marry their investments. They marry the principles that guide their decision making. In 2025, this adaptability will be more crucial than ever. We're entering an era where economies are undergoing technological, political, and demographic shifts simultaneously. Artificial intelligence will disrupt industries faster than regulation can keep up. Geopolitical tensions will alter trade routes and capital flows. Demographic aging will change consumption patterns, while new generations will drive innovation in digital assets, sustainability, and decentralized systems. Every one of these factors will create winners and losers, not just in companies, but in asset classes themselves. That's why identifying assets that thrive under change means looking for resilience and innovation, not stagnation and dependence. Assets tied to new forms of productivity, renewable energy, digital infrastructure, automation, and data analytics will likely outperform traditional models reliant on cheap labor or outdated consumption habits. The world's value map is shifting, and so must your understanding of what real wealth means. Real wealth is not just money in a bank account. It's the power to maintain and increase your quality of life regardless of what happens around you. It's security during uncertainty, opportunity during crisis, and freedom during transition. To build that kind of wealth, you must align with forces that drive progress, not speculation. Look at every major wealth-building era in history, the Industrial Revolution, the post-war boom, the digital revolution. The people who thrived were not those chasing fads. They were those who understood where productivity was expanding and positioned themselves early. The principle hasn't changed, only the tools have. So as you move through 2025 and beyond, remember returns are the outcome, not the goal. The goal is to hold assets that have meaning, utility, and durability. Things that work even when the environment changes. That requires patience, education, and humility. The markets don't reward arrogance, they reward awareness. In the end, wealth creation is a reflection of how well you understand systems, economic, psychological, and human. The better you understand them, the more likely you are to position yourself where value grows naturally. Don't chase returns, chase understanding. When you understand why something creates value, you can hold it with conviction through cycles. Because in every era, whether it's the 1920s, 1970s, or 2025, the principle remains the same. True wealth is built not by predicting the future, but by owning assets that make the future better. And those who grasp that truth will not just make money, they'll build something enduring, something that lasts far beyond market cycles, real compounding wealth. Diversification across uncorrelated assets is no longer optional. It's the ultimate strategy for survival and growth in uncertain markets. Most people think diversification means simply owning a lot of things, but true diversification is far deeper than that. It's about understanding how different assets behave under different economic conditions and combining them in a way that ensures your portfolio can endure anything. It's not about having more investments. It's about having the right mix of investments that balance each other through the cycles of expansion and contraction, inflation and deflation, optimism and fear. Every economy operates in cycles, and those cycles repeat because human behavior repeats. When times are good, people borrow, spend, and invest more. When times turn bad, they contract, sell, and hoard. These shifts create booms and busts, waves that drive all markets. The problem is that most people build portfolios only for the current wave, not for the next one. They feel safe during expansions and surprise during recessions. But those who study cycles know that both phases are inevitable, and that's why diversification is a law of financial nature, not just a suggestion. If you look back through history, the Great Depression, the stagflation of the 1970s, the dot-com bubble, the 2008 crisis, and the inflationary comeback after 2020, each era punished those who were concentrated and rewarded those who were balanced. In 2008, people who held only equities saw their wealth collapse. In 2021, 2022, those who held only bonds or tech stocks were caught off guard by inflation and rate hikes. Each generation learns the same lesson differently. There is no single asset that wins in every environment. The world changes, the economy shifts, and the only constant is uncertainty. That's why uncorrelated diversification, holding assets that respond differently to economic forces, is so powerful. When one asset falls, another rises. When one market struggles, another strengthens. The purpose is not to eliminate risk, but to smooth it out, to create stability where chaos would otherwise dominate. It's like engineering a well-built bridge doesn't avoid pressure. It distributes it evenly so no single part collapses. Your portfolio should function the same way. Most investors think they're diversified because they hold multiple stocks or maybe some bonds and real estate. But when crises hit, they discover that all their assets move in the same direction, down. That's because what they owned wasn't truly uncorrelated. Real diversification means owning assets driven by fundamentally different economic factors. Stocks are driven by growth and innovation. Bonds are driven by interest rates and inflation expectations. Commodities are driven by scarcity and demand. Real estate depends on income flows and demographics. Gold responds to monetary confidence and currency strength. Digital assets react to technological adoption and network effects. Each plays a unique role in the ecosystem. To create balance, you must understand how each reacts to changing conditions. When inflation rises, cash loses value, but commodities and real assets typically gain. When growth slows and rates fall, bonds perform well. When productivity surges, equities rise. When trust in fiat currencies declines, gold and alternative stores of value become